Hello and welcome to this week's Global Market Outlook. I'm Tolga, here to give you a concise recap of the past week's market action and a preview of the events that could shape markets in the days ahead. After recent turbulence sent the S&P 500 into correction territory, US equities managed to edge slightly higher, while Europe continued its impressive year-to-date outperformance. Meanwhile, the US Federal Reserve chose to hold rates steady, global trade uncertainties lingered, and softening retail data in the US stirred a debate on consumer strength. In today's video, we will break down these developments, highlight the major movements across assets, and then look at the pivotal economic releases and central bank meetings on deck for the coming week. US stocks snapped a 4-week losing streak, with the S&P 500 finishing up about 0.5%. Gains were modest and choppy, reflecting an ongoing tug-of-war between buyers stepping into correction-level prices and lingering macro uncertainties. Meanwhile, the Federal Reserve kept its benchmark interest rate at 4.25% to 4.50% and reiterated its expectation of 2 rate cuts by the end of this year. Policymakers did, however, lower GDP forecasts and raise inflation estimates for 2025, citing increased uncertainty around tariffs and global trade. Technology stocks, including many of the so-called Magnificent Seven, continued to lag. The sector is down over 9% year-to-date, a marked contrast from its nearly 37% gain in 2024. In corporate news, share buybacks remain robust, with US companies spending almost 19% more in 2024 than in 2023, totaling a record-breaking $943 billion. European equities held their ground, posting a fractional gain and lifting the region's year-to-date return to around 14%, well above the S&P 500's 3%. Ongoing concerns about trade headwinds haven't had derailed Europe's equity momentum yet, though central banks remain cautious. The Bank of England voted 8-1 to hold rates steady at 4.50%, citing persistent inflation risks. US still says disappointed for a second month, rising just 0.2% versus consensus expectations of 0.6%. The weak consumer trend is raising questions about the economy's near-term resilience. In the geopolitical level side, heightened tensions in the Middle East and growing concerns over US tariffs on major economies kept risk sentiment in check. Overall, global stocks ended slightly higher, the US dollar traded choppily, and bonds saw a modest rally as investors digested central banks' dovish undertones balanced against inflation pressures. Let's turn to the key events and data releases that could move markets in the upcoming week. Monday, global PMIs. Flash PMI figures from the Eurozone and the UK will reveal how manufacturers and service providers are coping with potential US tariffs disruptions. A soft reading could further push the ECB or Bank of England toward a more dovish stance, while any upside surprise may boost sentiment. Tuesday, it is US Housing and Confidence Day. In the US, we will see the S&P Case-Shiller Home Price Index and new home sales. Housing is a vital economic barometer, especially as rising mortgage costs test home buyers' resilience. Also watch the Conference Board's consumer confidence gauge for clues on consumer sentiment following weaker than expected retail sales. Wednesday, inflation spotlight. UK CPI data will be released. Markets expect a slight easing in headline inflation to 2.9%. Any upside surprise could complicate the Bank of England's current pause on further rate cuts. Australia monthly CPI. The Reserve Bank of Australia recently cut rates, and another inflation reading at or above 2.5% could shape expectations for additional policy moves later this year. US durable goods. This is a gauge of corporate spending appetite. Any weaknesses might reinforce slowdown concerns, but a beat would ease growth jitters. Thursday is a day of GDP data in Mexico. US Q4 GDP final data will be released. Investors will look for any revision to prior growth estimates. The trade balance and jobless claims will also come out. offering a more complicated picture of the economy's health heading into Q2. Mexico's central bank, Banxico, previously cut rates by 50 basis points. Markets expect commentary on the spillover effect of tariffs and how these could affect inflation and future rate decisions. Friday, it is a US PCE and European Indicators Day. The Federal Reserve's preferred measure of inflation is due. Consensus see a 0.3% month-over-month increase, which would keep core inflation hovering around 2.7% year-over-year. Any upside surprise could challenge the Fed's wait-and-see approach. Eurozone sentiment. Data on business sentiment and German unemployment will shed light on Europe's near-term outlook. UK retail sales, another reading on consumer spending, crucial as the UK balances potential spending cuts with lingering cost of living pressures. In addition, keep an eye on geopolitical developments in Asia and the Middle East. Heightened tensions can spark safe haven flows into gold or the US dollar and sway overall market risk appetite. In summary, markets have found a temporary footing after several weeks of volatility. Looking ahead, inflation reports, central bank updates, and consumer data will be front and center, especially as policymakers try to gauge the impact of geopolitical flare-ups and trade pressures on the global economy. Thank you for tuning in to this week's Global Market Outlook. If you found this update helpful, be sure to give it a thumbs up, share your thoughts in the comments, and subscribe for weekly insights. We will be back next week to keep you updated on all things market and economics. Until then, stay informed and invest wisely.